Welcome to the Page One Podcast, a podcast featuring a variety of guests and thought leaders on topics ranging from digital marketing, sales channel strategies, influencer marketing, best-in-class product launches, and all the details about how to accelerate sales. Now, here's your host, Luke Peters.
Thanks for joining us on the Page One Podcast. I'm your host, Luke Peters, CEO of New Era Appliance and Retail Band Digital Strategy Agency. Business owners, do you wish you had someone to create a custom strategic plan to grow your online sales? Online sales focused around Home Depot, Wayfair, and channels other than Amazon? Someone to help show your team actually how to execute this. That's what we can do for you with Retail Band. Find me on LinkedIn or email me at luke@retailband.com. In this episode, you're going to hear from Bryan Piskorowski. And Bryan is a managing director, head of advice and investment guidance at Wells Fargo Asset Managers. Is that right, Bryan?
Asset Management, yes, sir.
At Wells Fargo Asset Management. Cool. And we're going to talk about specifically how you should be investing your capital, both short-term and long-term. We got a lot of business owners in our audience, so I'm really excited to dig in here. Bryan, thanks again for joining us on the Page One Podcast.
Sure. Thank you, Luke. Appreciate being on the show and being able to spend some time with you all.
Yeah, this is going to be a fun hour or so. And Bryan, if you don't mind, if you can just kind of fill in the blanks on your background, you've really got an extensive, lots of experience. Would love to hear a little bit about that.
Sure. I've been with Wells Fargo and predecessor firms for 25 plus years. As we all know, the financial services industry has gone through a lot of permutations, mergers, and combinations. And so for me, Wells Fargo is just another step in that journey and offering that side out. I've worked both on the asset management side most recently, but also in the brokerage side of the business, so known to the public as Wells Fargo Advisors. There I've had several roles, both in research, sales, and trading. Focus of my career really has been, understanding the needs of clients and then, working with the product sets and building new product sets to be able to help deliver those needs. So, be it looking at income models and portfolios and things of that nature. Spent a fair amount of time in my early years. I'm born and raised out of New York. So worked at Prudential Securities in New York on trading desks there. During the big 90s, shall we say, during the tech boom and craziness and things therein. But spent a lot of time in the financial media, and as that's kind of turned into its own industry in its own right. But at the corner of it's really getting an understanding of what a client's needs are and building a comprehensive solution, hopefully to give them the best chance of meeting those needs, both on an individualized level or for companies and for corporations. And so being able to apply that is really important from my standpoint, I think, as well too. I do spend a fair amount of time teaching, so I teach a couple classes for the SIFMA program at Wharton at UPenn. And so maybe we'll get into some of those ideas today too, and just some concepts around that aspect of portfolio construction, design, modern portfolio theory, income generation, and things of that nature. But it's the best thing about being in this side of the business is, you wake up each day and and it's always a brave new world and something's always changing. And I live by the guideline that Mark Twain once said, history doesn't repeat itself, but it certainly does rhyme. And I think there's a lot of that that's really true in investing and looking at markets on a macro and a micro standpoint.
Well, cool. Well, thanks for that intro. And I was going to fill in a little bit on the education, but you guys heard there that Bryan is teaching at the Wharton and also graduated with securities from the Securities Industrial Institute at the Wharton School. And he's had a lot of appearances on CNBC, Fox News, AP, Reuters, Wall Street Journal, New York Times, USA Today. So this is a special episode on the Page One Podcast. Usually we're talking with business owners in the industry, but I know you guys are always looking for investment ideas and how to protect yourselves. And we're going to specifically talk about industry related topics, looking at inflation, how that might look in the future and questions around that. So Bryan, why don't we start here? What is your 1 to 2 year inflation outlook? And the reason I ask this is, obviously every decade it seems there's more money printing, but this is like the ultimate amount of money printing, right? If a new stimulus deal is passed, which I know the president kind of held off on yesterday, it would be something like $5 trillion this year of maybe it's not all money printing, but a lot of extra money being generated there. But yet we haven't seen any inflation. It seems like we haven't seen any, at least in the CPI. So curious to hear your thoughts in the next 1 to 2 year time frame.
Well, I think first, looking at the current perspective for inflation, I think we need to kind of look at where we've come from. And so, I was born in the early 70s. Inflation, was running, single digits. At the end of the 70s, it was looking like it was going to run at double digits. And you think back to those times and periods. I mean, that was when we were kind of running into an inflation issue. Obviously, in my adult life, we have basically been in a deflationary or disinflationary type of spiral. From my standpoint, I mean, there's base cases for what made this happen. First and foremost, would be the globalization of our economy. Obviously, I saw this coming through the eyes of my 12-year-old last year when we were buying a new flat screen TV, and we kind of walked into a Sam's Club, looked at a 72-inch, ultra high def, 10 million K, whatever it is, TV priced at $462. And when a 12-year-old can look at you and go, shouldn't that be more expensive than that? He made the mistake of saying that because then I gave him this deflationary kind of talk, and the fact that globalization has brought a deflationary, pushback into our society that we've reaped the rewards of from a cost of goods sold perspective. I can make the argument that China has been exporting deflation onto our shores for the better part of the last 2 decades, and at that same time, though, when you think about what drives inflationary spirals, and we go back to that period in the late 70s, a few things come to mind. First would be the fact that we had a much more industrialized economy than we have today, right? And thinking about today, for example, we're 70+% services related, less than 30% industrialized. And often comes with industrialized businesses is there's also more union labor. And we've seen the secular decline of unionization, over the past 35, 40 years. And those were all contributors to what drove that inflationary spiral in the 70s. The concept of cost of living increases, COLAs, would be automatic pass-throughs based off of your reference there, Luke, on CPI, right? And so there would be an automatic uptick at the rate of CPI, which, running through the end of last month was running at a 1.8% clip on the latest reading, and will probably average on 2020 probably 1%. So we're far afoot from the days of the 70s, and then add in obviously the drop in input costs as well. When you think about input costs, particularly coming out of the energy sector, when I need look further than the gas pumps, and particularly for you on the West Coast, I think that gas is a lot. I mean, it's always more expensive in California than anywhere else anyway. But we're not talking $6 and $7 a gallon these days. I would imagine. I haven't been out to the West Coast in a post-COVID world, but when you're looking at, you've got crude here trading, well off of its highs, well off of its all-time spike highs of 150, trading around $40 a barrel here. You don't have that inflationary input as well. And so you put all those things together, I think one can make the case that globalization, looking at the fact that lower input costs, and looking at the fact, particularly here in the U.S., and the lack of that major pass-through coming from the cost of living adjustment, that makes the case that it's not a massive inflationary spiral. Which, by the way, to your point, though, is not to make light of the fact that the printing presses have been running, and that we have seen an extreme amount of debt, be created here in this year of 2020, which is basically when one should expect anything but the norm in that type of year. As we look forward here, will that have an impact on potential forward inflation? Yes. I know for one, when we're building our capital market assumptions, these are the base cases. These are the estimates of what we think each asset class would do on a go-forward basis, looking out in the next 10 to 15 years. One of the key inputs to what that asset class will do is the base benchmark inflation rate. But over the last 10 years or so, and this dates back to my work with Wells Fargo Advisors in the investment policy committee there, we brought down our overall expectation on inflation. Used to run 3.5%. Now running about 2.5%. Which is well above where we stand today, or our forecast for next year, which is to see inflation rise about 1.7%. But when I build a portfolio, when we build and construct investments for clients, 1.7% inflation, while it does seem low, 2% inflation will cut your standard of living by a third over the course of 20 years. You still need to be, keep an eye on that, right? $1 today will buy you 66 cents worth of stuff 20 years from now. But definitely not at the rate of hyperinflation per se.
Yeah. So it's not,
and a lot of that just really stems from the fact that we don't exactly have expansive growth both here and abroad. Were we to see a sharp tick up in growth, I think you'd see a commensurate rise in interest rates. But given what we've experienced here in 2020, not only in the U.S. but on a global macro basis, growth is not exactly a runaway train. And it's hard to get a lot of inflation when you don't have that kind of growth, when you don't have that, that rush for the same sets of resources.
yeah. Okay. So, and just so the audience knows, we'll talk about gold and some of those other things later, but okay. And, so the idea is, hey, we're not going to return to the 70s basically, which is your thought there. So the inflation will stay relatively low. How dependent is this recovery on more stimulus? It seems obviously, if stimulus is cut, the market drops a few points and everybody freaks out. So this 2-part question is like, how dependent is it? Meaning, is it going to drop 30% back to COVID lows if the government suddenly stopped? And how likely is the government going to continue to add stimulus? It looks like they're going to. And I'm thinking for our business owners, we're thinking here somewhat short term. So we're thinking Q1, Q2 of next year, how is the customer going to be doing?
Sure. And so I think there's a few things perspective to look at that. I think what you teed off here with, Luke, was looking at it from a fiscal stimulus standpoint, right?
Yep.
So putting cash in the hands of people, increasing the velocity of money, which has always been a key component, especially in an economy like ours, as I mentioned, is 70%, 70% services. So every dollar that goes into an extra dollar into some waiter or waitress's tip, is money that then gets spent elsewhere and has a multiplier effect. Yeah. But I think the markets today, where they stand today and where they stand on a year-to-date basis, have been supported by several different aspects of stimulus. One of which would obviously be the fiscal stimulus we've seen here, but I think more importantly, and I think if we're thinking beyond just the next 2 or 3 quarters, we need to also understand the blunt force instrument that is monetary stimulus. The fact that we're sitting with a zero interest rate environment. There is no return in a risk-free rate of return per se, or single-digit basis points, in that case, and that the monetary stimulus has been immense this year, and we've seen the Fed continue to basically voice their perspectives as to not be to be in any kind of rush to raise benchmark lending rates, let alone also obviously all the additional stimulus that was thrown in the March-April timeframe. And when you really think about, what transpired when COVID first went into full-blown lockdown for all of us here in the U.S., the Fed basically developed a playbook in my mind in the 08-09 timeframe, and to one degree or another, it was kind of ad hoc. It was we've got a big fire, let's throw this bucket of water and see if that works. Let's throw another bucket of water. And that was built over a period of 18 months. And under the auspice, though, we hope we would never have to go that direction again. You fast forward from 08-09 to here in 2020. The interesting, kind of silver lining to that cloud that was 08-09 was the fact that the government has a very good playbook now to how to hit the panic button. I think more importantly, though, what was really essential to the V-shaped market recovery if you measure the S&P or do the inverse with interest rates, right, would be the concept that, basically they took out a bazooka, used every trick in the book in the space of not 18 months, but 18 days here in 2020. And so running interest rates to zero, building all this quantitative easing and acceptance of more than just treasury bonds as far as collateral and things of that nature to basically shore up the system. So there's been a massive amount of monetary stimulus here. And it's not our expectation at Wells Fargo that that is going to change over the next 12 to 18 months at the very least. And if it were to change, it would be a function of the fact that the economy is growing much faster than expected, and there could be a potential specter of inflation. In which case, I think from an economic standpoint, that's the type of change that a lot of folks would probably look fondly on. But we're definitely not at that point right now. We're still in a slow global growth, slow U.S. growth environment. We're still dealing with the impacts of the COVID crisis. And as such, you still have seen some dampened consumer behavior. And so So it's my expectation, though, that the stimulus package, not having a stimulus package, clearly we have a market that is susceptible to the swings and arrows of those types of headlines. And so I think that that's something that we do need to be aware of. But I don't think between now and year end, where we're not to get a stimulus package, that the economy is going to go to heck in a handbasket. But I definitely think it would have an impact on equity prices and how we value and how we evaluate equity risk in the market.
Yeah, that makes sense. Okay. And then somewhat related to that. So again, we're thinking short term, and business owners, some tax, actually extension time is coming up right on us right now for taxes. And then business owners are thinking about, their quarterly tax payments or even just if they've profited and what to do with the money short term, right? Because they might need to reinvest it next year. What is the best place for business owners to put cash short term right now? Interest rates are near zero. It doesn't seem like there's any riskless areas to make, money markets aren't paying much right now. So I guess, there's going to be some risk to make some money. And what would that be on a short term basis if business owners wanted to take a small to moderate amount of risk over, say, a 6-month period?
All right. So, obviously, to your point, there is no free lunch. You can't have, can't have a riskless trade without taking and get any yield for it. But I think in looking at that, I think there's a couple of parameters that one needs to focus on. First and foremost would be, what are my liquidity needs? When are my liabilities going to be coming in? I think that's important from a standpoint of basically saying, you need to have that liquidity for when that liquidity is needed. So, obviously, I think we're talking inside of 6 months here, in that type of time frame. You can pick up some yield, as you look to, basically take on what we call credit risk. Obviously, repayment risk and the credit quality of the issuer. And you can do so in, some short-term, instruments in the money market space, in the mutual fund space. But I think, liquidity is the kind of the paramount aspect of that, and variability of the value of the assets, or the, NAV, as we say, net asset value. And so, those are the parameters that play in. You can be rewarded if you're willing to, if you don't need a completely stable, never break the buck type of instrument, and actually pick up, and actually pick up income and pick up yield. And obviously, I think the goal for any of these types of scenarios is, trying your best to basically, get past the current inflation rate, right? So you're not losing money by sitting in cash.
Yeah.
But honestly, the issue is that the whole point of what the Fed has done with their, with the zero interest rate policy and a quantitative easing program is to basically make that cash painful for holding, and to basically accentuate the velocity of money into the system. To incent you to want to invest, to incent you to want to, into purchase and so forth. And so, that is the issue with this. But, obviously, you've got treasury bonds, you've got, for this case, you have treasury bills, but they don't have that much yield in any way, shape, or form. And when you look beyond that, though, by taking on credit risk, you can pick up yield on that space. But again, it's what are your an individual liquidity need for your business, for your personal finances on that space? Because right now, if you're looking out on 3-month bonds, they're only yielding 15 basis points, and you go out to 6 months, they're yielding 34. To basically get over the inflation rate, you have to go out to 10 years. So
it's so small. It's very unappetizing. Let's put it that way. What is on that same point, you're talking about the Fed is lowering these rates, and they're kind of, that's their idea. They want to force us to get, the investor to invest. Does that kind of kill or change the way that you guys think of the 60-40, quote unquote, the 60-40 portfolio, where, be 40% bonds, and bonds are paying so little right now. And it seems like they don't have that upside that they might have had in the past. Does that change how people think about allocation, moving more into equities?
Well, it's funny you ask that question, because we've actually done a lot of work on this. First, 60-40 has kind of been for all intents and purposes, right, the Goldilocks type of asset allocation, right?
Yep.
Not too hot, not too cold, just right. And I think, one, it's like looking at what the component of return would be. Obviously with bonds, I'm lending somebody $1,000 to buy a bond, and they're going to pay me back, say 10 years from now, if it's a 10-year long bond. And I'm going to get a rate of return, for basically lending them the money. And that's everybody thinks, well, okay, rates are so low right now, and if I were buying a U.S. Treasury on a 10-year, so I'm buying 2030s, 2030s are yielding 78 basis points. So you're like, well, I'm pretty sure the U.S. government's going to pay me back, but they're going to give me 0.78%, for my trouble. And that is one part of the equation. But the other part of the equation is actually something that I teach at Wharton, is kind of looking at the concept of modern portfolio theory, which, Goldilocks, not too hot, not too cold, also can be translated into, mom said, don't put all your eggs in one basket. But, when you look at modern portfolio theory, and Markowitz would say, not only by not putting all your eggs in one basket, is it not a bad thing, but it's also, it basically gives you a better return with less risk over time. Because, let's face it, you look at a year like 2020, this is the standout year for that 60-40 portfolio. And it's not because bonds have been such a great performer from a yield basis, but remember, as price goes up, yields go down. Bonds have performed very well from an overall performance perspective because of that drop in interest rates. And as such, you have a year like this where, equities have done actually I think equities have done very well. If you basically left me blind and just told me what has happened in 2020 and asked me to guess, what do you think the performance was in the S&P going into October, I would be very hard pressed to say the S&P would be up 5.8%. And it was up 10% at the big, about 3 weeks ago, right?
Yep.
You know what I mean?
It's hard to believe, honestly. It's hard to believe.
Yeah, and that's the case. If you look at that 60-40 type of portfolio, now this wouldn't be just S&P and Barclays Ag, U.S. stock to bond. But if I looked at the full pie chart and the full diversification with non-U.S. bonds, non-U.S. equities in it, on a year-to-date basis, that 60-40 type of portfolio is up about 3%.
But how about on a go forward though? Like the thing is, now interest rates are already crushed. Can you continue to make money with bonds?
Yes, and I think you can continue to make money from this. The fact that nothing dampens equity market volatility like bonds do. Right. And so I think that's the struggle that people have again. Now the other side of it though is if, when you look at the component of bonds, so this would be the argument of, if I'm going to lend the government, money for 10 years and they're only going to give me 78 basis points. Right. If I need income from that investment, yes, I think you'll need to get more creative. And I think it comes in two fashions. First and foremost, would be, if income and deriving income and yield from a portfolio is the key objective, the main objective, one should look to other asset classes to also help them get that yield, aka dividends coming from equities, be it looking at other alternative income type of sources, which often have some risk to them, but if you take it in small doses, can be additive to that type of income. But at the same time, you have seen this, right? What we say is 60-40 today used to be 50-50, 30 years ago. And you have seen some of these asset allocations kind of shape and morph. But here's the ultimate problem. The ultimate problem trying to build a portfolio that works, that is efficient, is that you need the fixed income exposure, because not only does it provide income, and maybe the total return is lower on it looking out the next 10 to 15 years, but it is the counterbalance, it is the ballast, it is that counterweight for equity risk and dampens the volatility. And so I think that's also a key component as well. But what you've seen overall though have been a slight reduction in the amount of fixed income in that type of Goldilocks type of portfolio in our industry over the last 10 or 15 years. I don't think it'll ever go to zero though, just because I don't think the average investor can really withstand the volatility that equities bring to the table, particularly as you look further down the path of life. If you're a 30-year-old investor, equity volatility, the money, you're not looking for the money to live off of for any period of time, 30 plus years. You can live with that. But you get to be 60, 70. You start seeing that level of volatility when you have a shorter time frame and a greater need for income in the distribution aspect of that portfolio. that it will still lead to bonds. But it does look to take on different risks. I think it also just plays into the fact of that diversification story, not in just stock to bond, but also in the kind of bonds that you buy. And then also looking at, what your individual tax situation would be as well. Clearly California is not light on the taxation story. And so, you think of things like municipal bonds, I can give you the same kind of correlation to equity risk in the muni bond space, albeit probably with better overall total return for people in the upper tax bracket. And so I think that's another variable that kind of comes into play in that space.
With and on that same question, with still bonds are going to be returning less, and like you said, the quote unquote Goldilocks portfolio has moved a little higher to equities. Is it advisable on your end for folks to put more of a significant amount in gold because of the money printing and just saying, hey, gold has to go up, but maybe that thought's wrong. I don't know. But is it instead of bonds, or some people can look at gold and say, okay, I want 20% in there, or play it with the gold miners or something to that effect. But what's your outlook on gold, and is gold a good counterweight to that volatility that you're talking about?
Gold could be a dampener. I think particularly in this type of environment, nothing really gold's unique. Gold is that, is that snowflake to some degree as an asset class. We lock that in obviously with our, with the commodity type of exposure here. But I think when you're looking at gold and think of it in that context, that, it has first and foremost, gold beauty is in the eye of the beholder, literally. I mean, you look at this commodity space. There is no real industrial application for gold, whereas I could say differently for things like platinum, palladium, and silver. Platinum, palladium, particularly just in the development of catalytic converters and things of that nature. But from a gold standpoint, is that it's kind of a universal type of currency, and there really isn't any more of it. You know what I mean? And so you can't just print gold per se. So we look favorably on gold right now. But as my wife likes to say, Bryan Piskorowski is best taken in small doses. So too, I think in many cases,
funny.
Gold should be of a portfolio as well. By the way, and I think in 2020, Heather Piskorowski is overdosing on Bryan Piskorowski because we've all been sequestered for so long. But no, I think that's the case of this. And I think when we speak of almost any one of these types of investments or asset classes, is that a diversified portfolio is just that. You have all these different flavors and spices that go into the overall recipe. But yes, I think gold. Gold had a nice run this year, up to 24%. I do not find that surprising, just given the amount of money printing not only here but abroad. I think from a perspective going forward here, though, I mean, gold costs you money to store if you own the physical. And obviously there are proxies that are out there for gold as well. And we do look, more favorably on gold as we move forward here. I'm thinking, looking out to 2021, potentially 2,300, 2,400 an ounce. I think we're around 18 and change today. And so, I mean, I think there's potential for that. But, you still need to sell gold to use it. They're always paying for anything in gold either. And so, something to keep mark on. But, as far as looking for inflationary type of installation, and the printing presses, and now that everybody's pretty much off the gold standard, to have an allocation to that. I mean, on balance, we generally recommend around a 5% allocation to commodities overall. In a diversified type of portfolio that may scale up a little bit to get into more aggressive asset allocations, but that gold could be a part of that.
Okay, great. That makes sense. And kind of, I mean, similar, I guess, on the same trend. So again, we have a lot of business owners, a lot of them importing from China, and want to talk about the recent, USD has devalued a little bit. I don't, honestly, if you look at older charts, not as much as it seems the media is making it into, especially when you look at a chart against the RMB, it's definitely not even at its lows in the last couple of years. But what are your thoughts on that trend on a go forward? That affects, obviously, that valuation right there can affect the cost of goods for those working with Chinese factories. Where do you see the USD going?
Well, we have a forecast to see a little bit more slide for the U.S. dollar, although remember, the dollar had gotten pretty strong. And so basically giving back some gains to one degree or another. versus renminbi versus yuan. Obviously, China's the development of China's industrialized economy has been predicated off of having a favorable exchange rate translation, right? And to use the flat panel TV example we did earlier in the podcast, and obviously remember too, that the U.S. RMB exchange rate does have people that play with it on an ongoing basis to kind of keep that range, stay in the range, to facilitate. So from a dollar weakness standpoint, I think you're just seeing that as kind of a post-COVID type of example, but also remember too, what was driving dollar strength was also a carry trade. So said another way, right? We've had sub-zero interest rates in Switzerland for the last 3 or 4 years, if memory serves. We basically had Europe sitting at a zero interest rate before COVID. And so think about this: if you were living in Germany and you have German bonds, that would be the German long bond, maybe yielding 10 or 15 or 20 basis points when we're at 87 today on the 10-year, but maybe we're at like 150. It might make good sense given the fact that you could sell your euros, buy dollars, and then buy U.S. Treasuries, right, and then pick them up at 1.5%, right? So it basically gives you 135 basis point yield advantage, and that could pay for the currency translation and the rate of return, right? And so, remember, as interest rates moved to zero here, that trade deflated because there was no point in sticking around, in U.S. yields if U.S. yields were comparable to those in other countries. And so, that brought, some of the unnatural buyer out of the dollar market, to foster a trade like that. And so I think that's contributed a little bit here. And so, something to conceive of, but I don't think that the U.S. dollar is going to heck in a handbasket and then we're going to get absolutely crushed on that standpoint, particularly also as we've seen, some of the trade saber rattling, abate, for exactly just because maybe there's other more hot topics that at hand perhaps, but I think for those that are sourcing in China, it's kind of along the lines of the same question that you often get. Will the dollar lose its status as the reserve currency? For the time being, I don't think so. Particularly, because the Chinese government does not let the renminbi float freely. You know what I mean? And so, if there's somebody else controlling the strings on what that exchange rate looks like, it's hard to be a reserve currency. And so, but I think big picture on this, though, we expect probably see a little bit of dollar weakness from here as we move in. That's generally our forecast. Both at Wells Fargo Advisors, Wells Fargo Investment Institute, and Wells Fargo Asset Management. Okay,
cool. No, that's helpful, and it seems like it's swung around. It's just got a lot of exposure, but that is really interesting. Kind of you describing that carry trade makes perfect sense, and kind of what's transpired over the last 6 months or so. Here's a question. This is short term and long term. So short term, where do you think, just let's call it the S&P is going to be at the end of next year? Just literally from now, is it going to be higher or lower? But then more long term, what sectors do you like? Looking back, I think I was looking at the Wall Street Journal over the weekend, and they showed who the biggest winners were and what mutual funds won, and every single one of them was like a QQQ or a tech or a chip fund or whatever, it's of course, with what's happened the last couple of years. So this one, the twofold is, where do you see S&P higher or lower at the end of next year? And then, but what sectors over the next 5 or 10 years do you think are the ones to look at?
Sure. Well, so from a market perspective here, we've got the S&P trading around 3,400 for let's just say better term, just for the record for everybody here too. S&P has always been kind of my benchmark. NASDAQ's kind of come and gone and come again. And the Dow Jones is, when I first started working on Wall Street, I actually worked for a guy from Brooklyn who had this awesome accent. And literally say, I got into the business because I fell in love with a 65-year-old guy from Brooklyn. But he would always, one would always quote the Dow, to which he would always bark at you. It's a 30 stock index. It's not representative of what this country's about.
Yeah.
But his name was Larry Wachtel, rest his soul. But for the S&P, we're sitting here at 3410 change here today. Obviously we're off of our highs for the year, but not that far off from the highs seen back in August. And it's our expectation that, with the restart of the economy, that's going to be, helpful to the overall earnings story. And that, maybe looking, 3,800. So modest gains from here. And, like we said before, Luke, the fact that we're up 5.8% and we're up over 10% at one point this year, I think is pretty astounding considering the year that we've had. So I think moderately higher here, predicated off of a resumption of recovery in overall earnings. It's not to say that the market's going to be willing to just blindly pay more, for the future. And so I'm looking for, basically a pretty substantial increase in the overall earnings of all the S&Ps combined, all the S&P companies combined on that front. And we're looking for lesser type of recoveries outside U.S. for the equity market here. And so you see a modestly higher equity market. Obviously, I think we'll have a positive impact on the economy overall as well. But when you think about that moderate growth in income, what we call that 60-40 type of portfolio, our average annualized return, on a normal year, not that any year is normal, and 2020 is far from normal, probably about 6.9%. And so, that's not a bad return for a blend of those types of portfolios. And right now, on a trailing 12 months, that number, if you can believe it, is 8.5. And so
it's hard to believe.
Luke, that speaks to the fact that equities have zigged and zagged, but bonds have rallied because yields have dropped, right? And so I think again, it plays back to that diversification story and how it actually does work. It doesn't work perfectly every day, every week, every month, every year, but you look over the long term, it actually plays out. As far as sectors go, listen, I think there has definitely been a skew, right? I think 2020 has definitely been a year where we've seen obviously a massive shift, just because people's behaviors have been influenced by the fact that we're all cooped up at home to one degree or another. So from that perspective, obviously, when you think of the names in basically, internet retailing, they used to all be in the tech sector. They're not all in the tech sector anymore though. And so we look more favorably in areas like communication services, which was not a industry sector as of 3 years ago. Consumer discretionary, which has been historically retailers, but now has names that used to be considered tech as retailers as well. And healthcare. Those are the three areas that we're most very favorable, and we're most favorable in infotech. And these are areas that have actually delivered a majority of the return in the S&P, on a year to date as well. And I think that's also something that's worth just considering. Just from the fact when you break down, the different sectors of the marketplace and, what has performed and what has done well, a lot of that, has been those types of areas. And it's not surprising to us from that standpoint, just because, there's been a dynamic shift in consumer behavior there. And so, obviously for the infotech, the problem with all infotech, as we all know, is they weren't cheap yesterday. They're not cheap today. And it's our expectation they won't probably be cheap tomorrow. Infotech, if you can believe it, has, over the last 12 months is up over almost 58%. And so, at the other end of the spectrum, Luke, what do you think would be the worst performing sector over the last 12 months?
Oh, geez. I don't know, maybe industrials or energy, maybe financials.
Energy. Yeah, it's energy. Yeah. So actually, the yin to infotech yang would be energy down 33% over the last 12 months. And so, obviously that's just come out of the fact that not only is economic activity overall lower, correct? But I don't know about you all, but people aren't driving nearly as much either. If we're not going anywhere, we're not going to the pump. And so
it's hard to see it coming back.
Listen, I think, at some point, honestly, and this is not an investment perspective as much as an opinion, but I do think that there's going to be a reactionary response to the fact that all of America has been cooped up since March. Be it things like concerts, sporting events, people being able to be with people. If hopefully we get to the day sooner than later where that can all happen again. I think that's just part of the American culture, and American experience. And getting to and fro will be part of that as well. So those infotech is definitely an area where we think that once you can't put the toothpaste back in the tube to one degree or another, and this may be playing to your audience, but from the standpoint of if you haven't gotten used to doing things online in COVID 2020, you have, and you've figured it out. Really doesn't need further than the fact that everyone knows how to use Zoom now. It's amazing for me to think just doing if I were to come out to see you all in California and do a client seminar would be one approach, but it clearly means no clients have a hard time getting on Zoom these days. And maybe it's the same way that my baby boomer mother has no problem talking to my sons via Zoom or FaceTime or whatnot. And so, in that aspect, I think that trend, we believe that trend should continue. Obviously, healthcare, be it where we are with the current COVID situation, we think and there's also just the demographic aspect of that as well, with the aging baby boom demographic that plays in. And then, areas that we don't look as spectacular, shall we say. Energy still remains, is an unfavorable area that we're not looking to accentuate or overweight. I would likewise say that I think a lot of people, in the same way that people have reimagined or rethought how they purchase things in 2020, I think people have also reimagined what they own and how much, and how they own it vis-a-vis real estate. And from an investment standpoint, real estate investment trusts, be it shopping, as we all know, there's been a secular decline of the mall environment over the last decade plus. But I think that's accentuated. And then obviously thinking about what commercial real estate looks like vis-a-vis office space. And I think there's going to be a lot of companies that are kind of reevaluating that since the majority of folks in the U.S. have moved to a work from home type of structure. Those are areas that we'd be looking to probably avoid a little bit more here. And despite the fact that they have not been, energy being down 33% the last 12 months and real estate being down about 4.4. So that plays in too. But
wow, well, that's super helpful. And we've covered a lot of ground. So hopefully, for the listening audience, you guys can have an idea of where short and long term. And I think the biggest point there that you just talked about, Bryan, was like a lot of these things have gone up, and you're looking at the PEs or whatever you want to look at when you look to invest in a particular stock. But in a lot of cases, they're going to keep going up. They're making a boatload of money, and actually, some of the PEs aren't actually a lot higher than stocks in these other sectors. So I think to your point, I think what you just said is that, hey, they're up 58% this year, but they're probably going to keep going up, in the years ahead of us as a whole. So it's always one of those things as an investor, you're like, oh man, Zoom went up too much. Is it too late to get in it? But then it just kept going up, and then people they still missed it.
But to your point though, Luke, remember that just because the market had a nice run and has gone up doesn't mean it can continue on, but it also doesn't make it susceptible to a pullback. And let's face it, as we look out definitely over the next 3.5 to 4 weeks, and through year end and into the beginning of 2021. There's definitely a huge, potential to see an uptick in volatility. And so I just think we all collectively need to be aware of that, that volatility is kind of, unfortunately, part of the world that we're living in today. And if you just think of 2020 in its own right, we basically, in this calendar year, we saw the end of the longest bull market in history, second largest in history behind the tech bull we had in the 90s. We saw, in my mind, the sharpest, swiftest bear market in the 25 years I've been doing this, and the dawn of a new bull and a new all-time high, all in 1 year. And so, which is not to say that we can't continue to see this level of volatility, which again plays back to me that concept for building portfolios for individual private clients, of having that diversification, despite the fact that you don't get a lot of bang for your buck in bonds today. And having that, relative to our discussion today on dollar, of having a diversified, well-rounded portfolio that involves not just U.S. stocks, but non-U.S. stocks. And then beyond that too, though, it's having someone to work with and partner with. And beyond just what the individual investments need to be, but in my mind too, this is a year where active management has definitely shown its cards. You just look at the bifurcation of returns from those different indices, sub indices within the S&P. Can make the case that some of these got different focuses and maybe tactical overlays that play into the areas that have done well, like infotech. Can produce superior returns. And I use the U.S. large cap market as an example for that, but that plays across the entire fixed income spectrum and as well as non-U.S. equity. And so, in my mind, I think that active management with this type of volatility actually has an opportunity to shine, and that's something that we should also just consider as we move through year end. But I think volatility is here to stay, and to be opportunistic, can play in. And I for one will say, when the market gets whacked around like it did in March and April, to see the recovery, the bounce, and more importantly, when people have very specific duties, as our portfolio managers do at Wells Fargo Asset Management. You see the bond market getting clocked, and our California muni team happy about it, which seems antithetical, but the reality is, remember, they like buying stuff on sale, and so for them, it's when you see those type of blowouts in spreads in this case, that they see those opportunities. To them, it's like, I know that's a quality bond, or I know this is a quality company if you're an equity manager. And you know what the intrinsic value is in your model, and that you see it on sale. That's an opportunity for, I think, active managers to shine. And so, we look optimistically as it relates to that in the active market, and being able to do so for our clients.
Yeah, I couldn't agree more. And that's a good example why, investors, it's good to have an advisor and your money with someone else who's less emotionally tied to it, right? When it goes down, they're looking for those opportunities to buy. And a lot of times on the individual side, it's painful for us, and we may want to pull out. So those are two big areas outside of just, nominal returns where, you can make gains just by being in the market and having the right person managing that money. And listen, I really enjoyed talking with you today, Bryan, and covering all these subjects. And I kind of wanted to finish up with a question, just with some pure advice from you. What's the best piece of investing advice you've ever received?
Yep. So for me, the one thing that, and I kind of touched on it actually in the beginning, I got into this business. I did not grow up thinking I wanted to be an analyst, a trader, on Wall Street. I actually was going to get my doctorate and teach history. And I was set to do so. For example, I wrote my honors thesis on declassified documents from World War II.
Oh, wow. I didn't know that.
So, but then I fell in love with this guy from Brooklyn, and I saw his side of the business. And the thing for me, really was the fact that what I love and the best piece of advice I ever got was, one, understand. It goes back to that concept of history, right? Like, we've seen stories like this before. The story never plays out the same, but there's nuances that play into every one of these types of stories, be it bull markets, be it bear markets. And the constant through all of that is human behavior and human mentality. And I look at this with an investment lens. I'm sure everyone on the podcast that listens to this is looking, understands that aspect of human behavior as they run their businesses. That was the carry through here, of being able to kind of disassociate yourself to one degree or another and look at the big picture. And so for me, it was about looking at the history aspect of that. And I sit here in front of my Bloomberg having this discussion with you today, looking at a 30-year chart on the S&P to kind of give me a frame of reference. And it helps in two ways. One, you're like, wow, the market's done pretty well over 30 years. Two, you look at this year, and in that 30-year period, it's never been as volatile as it's been this year either. So it gives me a frame of reference there too, relative to that. But I think the big story on this is that the frame of reference is you pull the lens back far enough, and I think it plays back to the theme that I've kind of come back to through our session here today, which has been diversification actually works over time. And you run through periods where active outperforms passive, passive outperforms active. You run into periods where growth outperforms value. You see Business Week say, well, Warren Buffett's value investing style is dead. Only to see, after the late 90s, that value story play on. And so the fact is that there's a cyclical nature to some of this, and you just have to actually look for those type of waypoints. And so for me, the best piece of advice was, if you know your history, you'll have a much better chance of being able to navigate the future. So kind of looking at where we've come from to get an understanding for that.
That's great advice. Keep reading, keep learning, be curious, and you'll make better decisions. Man, listen, I really Really, really appreciate you taking the time out of your day, Bryan, to hop on the Page One podcast. How can listeners, learn more about you or maybe contact you or your team if they're interested in investing with you?
Yep. So Wells Fargo Asset Management.com is where our shop holds all our things. We have a Voice Advantage blog that a lot of folks can check in. And then I for one do not work with the public, but my good friend Jeff King is the one who kind of put us all together for this, and he's a great resource for me and a good friend as well. But I think the big story of this is take a look at wellsfargo.com. You get a lot of our information, a lot of things we discussed here today are all available right on our website. And I think it's definitely worth checking out.
Awesome. Thanks for that. And Jeff King, that's King Financial Group out of Seal Beach, California. And we'll have all this in the show notes. And again, I want to thank everybody for listening to this episode of the Page One podcast sponsored by Retail Band. Hope you enjoyed the interview today. I really appreciate your reviews. Makes a big difference for this podcast if you guys can take the time to write a review on iTunes, and hope you join us for the next interview. Take care.
Thanks for listening to the Page One podcast with Luke Peters. If you enjoyed this episode, please help us out by leaving us a rating on iTunes. Want to double your online sales? Check out www.retailband.com. And don't forget to join us next week with our next amazing guest.